Welcome to the Investor Summit Green Room, the behind-the-scenes monthly podcast where we bring you informal one-to-one interviews, panel discussions and presentations with fund managers, city professionals and financial journalists. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. Today we welcome Sue Noffke, Head of UK Equities at Schroders, to the Green Room. Welcome, Sue. Schroders is one of the UK's largest investment managers, and Sue has overall responsibility for over £6 billion worth of assets under management. She also runs the Schroder Income Growth Fund, an income investment trust. Welcome to the Green Room, Sue. It is a huge pleasure to have you here today. So let me ask you about the summit. Let's start with the summit. You very kindly came and supported us last August. Can you remember what it was like? Take us back there.
It had an immense atmosphere, actually. I haven't been to many of these conferences filled with retail investors. Mm-hmm. And it was at the Chiswell Street Brewery facility. So I remember that from back in the day. Had a real buzz of congregating people. And then I was on one of the panel sessions. I can remember being on stage and seeing a sea of people. And they were quite interactive. The microphones were going around. In the Q&A session, people were prepared to ask their questions, things that were important to them.
And Annabel Brodie-Smith was moderating, and she is a force of nature. We always end up talking about Annabel because she just is such a unique human being. She's done a lot for investment trusts, hasn't she?
It's really her passion. And I think one of the things that she brings out is really the validity of something that is an ancient investment product for individual investors into the modern times, and shows how these vehicles can still be fit for purpose for people's investments today.
Yes, indeed. Yes, if you're a long-term holder, investment trusts are a good way to go. So I'm delighted to have you on we've changed studio. It's not actually a sofa, but I'm delighted to have you in the studio with us today. I'm going to ask you straight out, what does it feel like to be managing £6 billion worth of assets? That's quite a big deal in my world.
It's a lot of noughts, isn't it? It's a lot of money, and that comes with a lot of responsibility. Responsibility to the clients. It really hits home when you're face-to-face in a physical meeting or online meeting, as sometimes happens in today's times. But it is meeting those end clients. We started off talking about investment trusts. Mm-hmm. And often I'm coming face to face with the end individual investor. And that is very revealing to me about what they understand about the strategy, what's important to them, how long they've been holders. And you feel very accountable and responsible for what you're delivering, the income return and the capital return. Mm-hmm. On the institutional book of business that I run, again, it's a massive responsibility, but it's different. The time horizon's different. They're very much taking the responsibility on behalf of all the individuals behind, whether that's a life insurance company, big pension fund, local authority pension fund, or a discretionary wealth manager. There are all sorts of different clients that I'm managing money for, mm-hmm. but they all have their expectations. They all want to know that you are accountable, that you're taking robust investment decisions, and that you have an investment philosophy and an investment process that you adhere to, that they understand, that has delivered for them and their end investors over time.
Which takes us very nicely to the process. What are your parameters, and how do you actually manage that money? What are the skills required to manage that amount of money across all these different clients that you've just outlined for us?
Yeah, there's a lot to unpack in that. Shall I start at the high level of what makes us different? is that my process, which I've been honing for the last 20 years or so, is a style neutral approach. So that's building a portfolio that has different stocks that will be value and growth characteristics, but building a portfolio that has a robustness of style neutrality so that it's not particularly buffeted by those style headwinds and tailwinds that can be driving forces for markets at particular times. So diversifying the portfolio characteristics, but building it from idiosyncratic stock picks. So what does that mean? It's the fundamentals. So finding investment cases that we think are mispriced by the market. It's a little bit like a treasure hunt and looking for those nuggets of information, nuggets of understanding.
It's never easy because everybody else is looking for exactly that same mispriced investment, aren't they?
You're exactly right. So you have to do things in a slightly different way. You can be methodical, you can be somewhat longer term in nature, you can be patient, you can look at a number of characteristics that we focus on would be the balance sheet and the business model, the management, the sustainability or defensibility of the business model, often called the moat, to really consider the valuation in the context of its past history and in the context of its peer group as well. So looking at potential opportunities through lots of different lenses, kicking the tires, not rushing to judgment in many cases, but we will have a deep understanding of what it is that makes that company tick. But it's not a question of just buying the best companies. It's buying the best investment opportunities. And sometimes that can be tarnished silver that you're looking for the investment case to polish up a little bit.
You're looking for a recovery stock type thing.
It could be a recovery stock. It could be a company that has invested for growth that the market has not really latched onto because it's depressed earnings rather than being in the shop window. And so letting that come to...
new, for example, AI. Relics are introducing AI at the moment and the market is not liking it.
The market is really gone from AI as something exciting to price highly and looking for winners to suddenly this year being very fearful of what damage either the spend or the indefensibility of what we're seeing as very strong moats to the business case and future profitability.
So do you take an intellectual approach to it? Do you, is it all about the numbers? Is it a degree of gut instinct on top of it all?
It's a blend. Clearly, investment experience does count. I think long-term investors who've got a few grey hairs, like me.
You've seen the cycles. Because at the end of the day, it's all about cycles.
You can put it into context. You've seen some of the pitfalls. You do feel that gut instinct. You can compare to things in the past. You know, the numbers do count and the quality of the numbers do count. We run scenarios. So we try and take a blue sky. What could go really right? And what's the upside if that's the case? What's a base case, and what's a downside risk? How bad could it get? How much money would you potentially lose? What would happen in a difficult circumstance? Would the company find that it's running out of money on a cash flow or a balance sheet basis and have to raise capital? That's never good as a shareholder. So blending those different things. We also put store in meeting the management, understanding the board constraints or how much whip is put, as well as the carrots and the incentives behind what management compensation can be.
Presumably you've got a team who are all tasked with looking at different elements of this big picture.
It's not all about me.
I'm sure it's not all about you. So how often does that team get together? Do you physically get together? How does it work?
Well, I work in a team of 4. in the prime team, that 6 billion of assets that you talked about. There are 3 of us that are portfolio managers. We come together on a daily basis, but formally we sit down twice a week to really consider all the meetings that we've had, to debate the priorities, to look at what's floated to the top in terms of attractiveness, things that we would be thumping the table that we really need to get into the portfolios, more of in the portfolios, or out of the portfolios.
And how often would you say you trade?
Less than the average, but it depends. At the moment, there's a lot of debate going on in markets and around different themes, different stocks. So there's a little bit more turnover in recent weeks and months than has historically been the case. Sometimes in quieter markets, you just have to sit back and let your portfolio deliver, or you're spending time really agitating for change, but you're pushing and doing more work rather than running around changing the portfolio.
It seems to me that it's possible to make quite a lot of money at the moment, but also equally easy to lose money quite quickly.
Yes.
That's from my very naive perspective, that's what I'm finding.
We're finding that we're asking a lot of questions and trying to debate about what the answer is, what's knowable, what's not knowable. We're very valuation disciplined, so sometimes that tells you to take money off the table, even though everything looks like the sky is clear, the sun is shining, but you know that it's all in the shop window. And it doesn't take much for some negative to come along and perhaps dent the investment case. So we try and be disciplined on valuation, sell high and buy low. It sounds very easy, but it's quite difficult to do in practice.
Fundamentally difficult, but it's what everyone is trying to do indeed. UK stocks are your speciality. So where is the FTSE at the moment? Give us your perspective on where it's been, where it's at the moment, and where it might go to. What are your thoughts around this? It's had a pretty good run, bull run.
It's had an amazing run. Last year was up almost 25% on a total return basis for the top 100 companies. And on constant currency terms, that put it in kind of the top end of global equity returns. That's good. We know that the UK market has not always had its time in the sun, but there was that famous quote of Jurassic Park, which was made in end November, beginning of December 2021. And since that moment, we've actually had good cumulative returns from UK equity assets over time. A lot of that has come in the last 2 years. The good news is that those returns look as though they could be sustained because the valuations compared to other equity assets don't look stretched compared to their own history and compared to other equity classes. And what is it that's driven those strong returns? Well, at the beginning of 2025, it was all about aerospace and defence and banks, but that broadened out a little bit. So the second half was about pharmaceuticals got added, and mining stocks came into place, and the commodities really rallied in the second half of 2025. I think that there are lots of attractive opportunities within the market in the UK.
Where are you seeing attractive opportunities in terms of trends, but in terms of stocks as well? So we've got people who are listening to you going, okay, come on, spill the beans, Sue. Yeah, what are you talking about?
I think there are still legs in a number of those sectors that led the market last year. I would particularly call out pharmaceuticals and the commodity areas. Mm-hmm. I think industrials, we've seen some of the economic data, the leading indicators called Purchasing Managers Indicators, PMIs for short, pick up globally. And that augurs quite well for industrial activity and the mining stocks to play into that.
Do you have some favourite stocks?
It's difficult to pick out favourites when I've got a portfolio of about 45 stocks. I think the kind of portfolios I run are not having 3 or 4 favourites at the top. They're much more diversified. Mm-hmm. So
I managed to put some money into Novo Nordisk, and then it went down 30%. So presumably that is not amongst your 45.
it's not amongst my 45, but GSK, GlaxoSmithKline, and AstraZeneca would be amongst the top 10 holdings in my portfolio. And they both had different histories. Astra is something of a darling, but has a fantastic pipeline still of potential new drugs to come to market. GSK has got new leadership. It's got a sales target that the market doesn't believe. So it's got everything to go for. It's one of those mispriced opportunities that I think if it can get some more confidence from other new investors, it can really close that valuation gap. So
you mentioned mining stocks. What mining stocks might you be interested in?
Well, copper is on everyone's lips, as well as the gold at the current time. But diversified miners are really appropriate for the portfolios I run. We've seen supply-demand dynamics really supportive for long-term prices. And although share prices have been quite strong in the last 6 months, our expectations are that they can still connect upwards towards the spot price. So if we see more robust economic activity, we've got electrification, long-term trends across the world, we've got security of supply and geopolitics playing into that. It looks a pretty solid place to be, and I don't think it really matters which names you've got. They've all got their own investment cases, whether it's consolidation, whether it's go it alone.
Would you be interested in copper as a commodity rather than as the miner?
I much prefer to play it through the mining company.
Yeah.
And looking at, for example, we looked at Rio Tinto recently, and iron ore is not the hot commodity of the current time, but it is kind of the ugly sister of commodities, and people think it's not very exciting. I love it because of the stability of the profit margins. The EBIT margin has been between 40 and 50% over a 30-year period, and it's in quite a safe part of the world, and that generates a lot of cash flow that can fund your exciting projects.
And the fact that the Glencore deal has disappeared, do you think it might reappear? And is that of interest to you?
I think what we're seeing is more excitement in the commodities space. I think all those geopolitics mean that security of supply is pushing corporate activity up the agenda. We saw BHP come in for Anglo American a couple of years ago. Anglo American had its own operational troubles, and it's really snatched victory from the jaws of defeat. So it escaped from BHP and has managed to shed some of its problematic areas to focus on the attractions, and it's managed to have its own tie-up, yet to be consummated, with Teck Resources of Canada, and that puts it in a very attractive spot over a medium-term basis.
I'm glad you're sitting on opposite me today. Fantastic. Very, very useful. I'm picking your brains at will. It's absolutely fantastic. Thank you so much. Let me take you to the FTSE 250. It's the UK FTSE 250 is a little bit unloved, but the earnings growth seems to be really beginning to come through at the moment. Tell me what your thoughts are.
Well, the FTSE 250 has generated tremendous returns over the very long term. But going back to that Jurassic Park kind of timeline of late 2021, that was the peak for the mid 250 index. And since then, it's been much more pedestrian. It hasn't fallen, but it hasn't delivered the goods in the same way as the larger cap component. And that's been a common thematic across global equity markets. The returns have been concentrated in more of a handful of large cap stocks and themes. And domestic stocks have had to weather the stormy weather of politics and consumer sentiment waxing and waning, and of course higher costs coming from government initiatives of national minimum wage and national insurance contributions. So it has been a tougher spot. The FTSE 250 is typically thought of as more domestically orientated, and it is compared to the larger cap names, but it's not exclusively domestic. It's about 50-50. Whereas the FTSE 100 is about 80-20.
Do you mean in terms of revenues?
In terms of
some
revenues
of the revenues
that
are
are generated overseas.
Yep.
So there are many FTSE 250 stocks that are domestic, but there are many that are much more international or are internationalizing. And I think that makes it a really interesting melting pot for active fund managers.
Do you have a particular preference? Do you like the ones that have overseas revenues as well or not?
I definitely do.
Your eyes are shining. You like those?
Yes, I do. I think that there are many stocks that fit those criteria. Can name some of them that have emerged from a UK or European base and have made the US quite a large part of the business. I can think of Computer Center, which does a lot of services for large corporates and enterprises, and is really sort of benefiting from the amount of spend on AI and infrastructure. And talking about infrastructure, there's Balfour Beatty, which is construction and infrastructure projects. Mm-hmm. It's big here in the UK on the nuclear projects. It's on bridges, roads, rail projects. But it's also big in the States, again on rail and again on purpose-built accommodation. Mm-hmm. So like some of those angles where you're not beholden just to the UK, but there are also UK-focused companies within the portfolio.
And lots of M&A. Is the M&A a problem for you? Or do you quite like M&A? But once it's gone, it's gone.
That is the problem. Once it's gone, it's gone. So we need to have a balance of new issues coming to the market as well as price discovery. And that's what M&A is all about. If the public markets don't appropriately value those businesses, then a private equity or an industrial buyer can pick those up. But what we want is to be an attractive space for companies to come and list, to thrive, to raise capital for future investment. And that should be a good thing.
Tell me about your investment mandate. Does it actually encompass AIM? I don't know if it does.
We can invest in AIM, and I have an AIM stock in the investment trust, that's Fevertree, mm-hmm. And that is a great example of a smaller company that was big in its domestic market, but has really got huge aspirations for making it big in colas as well as tonics in the United States. Mm-hmm. And just over a year ago, it had a tie-up with Molson Coors, who's investing in Fevertree shares and also investing in Fevertree in terms of its capacity and distribution in the United States.
Must be fantastic for distribution terms.
Yes.
Must be very helpful.
And it's not exclusive outside of the US, so there could be other tie-ups to be had in the rest of the world. So premium soft drinks are the new thing. We've heard about elements of moderation, but people are wanting to drink well, and what you put in your spirits is as important as the spirit itself.
You think Fevertree is doing well at the premium end, but people at Diageo are struggling. So
they certainly have struggled, and this is true of all the spirits companies. Possibly COVID, people indulged too much and stocked up, whether that was in the home drinks cabinet, maybe overindulged. There are lots of debates about GLP-1s, whether that is something. The youth of today don't seem to be drinking as much as the oldies.
I'm not so sure enough people are actually taking GLP-1s, otherwise Novo Nordisk wouldn't have had, the share price wouldn't have crashed.
Yeah. So these are debates because no one really knows.
The data doesn't underlie these conversations, unfortunately.
No, and we know that spirits is typically a cyclical sector rather than a structural growth one. And I think we've seen a cyclical, possibly some structural downdraft. We do have management change coming through at Diageo. So they've got an incoming CEO who's sort of earned his stripes at both Unilever in the past and particularly at Tesco turnaround, and then more recently as chair of Haleon.
It does seem a tough gig, though, to be fair.
None of these top jobs are easy. They really aren't, because you're under the spotlight. Even if you're doing well today, you've got to look far enough ahead to make sure you're spending on the right things. You're going to get the returns. You're not going to be disrupted. I think being at the top is tough, but no doubt rewarding.
Tough, but no doubt rewarding. Right. I'm going to pause there and go back to your early days, Sue. Imagine this is Desert Island Discs, and I'm saying, so tell me through sort of that moment in your life when you had your big break. Tell me a little bit about yourself. For me, it was the day I joined the Daily Telegraph, and my life was never the same again. Do you have a moment like that?
In a long career history, so I've got over 35 years history, there's well more than one moment. And of course, there was the very beginning.
Choose two.
I've probably got two, or maybe it depends on time, but I'll start at the beginning. And I was a student at Aston University doing a joint honours of business and biochemistry, and I'd opted for a placement year.
Stop there. Business and biochemistry?
Business and biochemistry.
Who does business and biochemistry?
Not many of us. I think there were 6 of us on that particular stream. There were more on the business side. And I think I thought I was going to be in some lab somewhere, maybe working ICI division, something like that. But I also applied for this thing in the City of London. I didn't really want to live in London, but I thought I can do it for a year. And I had interviews at the university, and then I came down to Schroders' offices, and I had a whole day of interviews. And at the end of the interviews, not only did we get to play with the data stream machine, but the last interviewer I had said, "I've got a company coming in. Do you want to come and sit in?"
Ooh.
And that really got me over the line. Plus the fact that I started work for my placement year in September 1987, and within 6 weeks I'd experienced a stock market crash and recovery within that calendar year. I just realized that it was such a meritocratic opportunity and sector of the market to work in. Every time you put your hand up and said, "I've done that, is there anything else I can get involved in?" someone would say, "Oh yes, over here, I need you to do that." So I see that as my big break. First break, but then there's lots of others.
And you've been at Schroders ever since?
I have been at Schroders ever since.
Is that a good thing or a bad thing? How would you characterise that?
I think I was fantastically lucky to land at such an early stage. I was just 20 when I started my placement year, but to land at one of the successful fund management companies. It was a division of Schroders at that point, but it had such a long runway of growth, and that offered up so many opportunities in my early days, learning from really successful investors who became mentors, but also having lots of opportunities to get involved in clients, running portfolios, and then managing people.
Now, trading moments, successful or otherwise. I'm easy. Tell us something that really stands out, a moment where you got it totally wrong. There was a lady I worked with who she was offered when Microsoft was being floated, she was offered a 1% stake and didn't take it. Did you have a moment like that?
No, I can't beat that one.
Not many can.
I have had a moment where I was in a taxi, and my boss called me, and we'd been to see one of our mutual clients, and he called me and he said, "Sue, that meeting went pretty well." And I thought, yeah, did go quite well. And he said, they've got another portfolio that they'd just like you to run. How about that? So that was amazing, and that hasn't happened again. Then there have been...
And how big was the portfolio that they wanted you to run?
This is kind of 25 years ago, and it would have been about 200 million then. So probably about $500 million or more in today's money, just like that. So
that was a good meeting.
It was a good meeting. It hasn't been
told your husband and
replicated.
said, "You're not going to believe what I'm going to be today."
And then the other one was we've all got comfortable with videos and podcasts and things now, but in 2014 there was the approach by Pfizer for AstraZeneca. And there was a bit of email chat internally because someone had asked a question and I gave an answer, and then it sort of got bounced around the communications teams. And then before I knew it, I was asked to do drive time comment on Radio 5, and by next door neighbour heard that. And then Radio 4 said, actually, we'd like you to come in and talk about that on air. And that was completely outside my comfort zone, particularly when everyone, including the chief executive at the time, was hanging on your every word. But it was important to discuss the options that were available, both sides. So that was what I would call diving in at the deep end.
Having worked at the BBC, I know exactly how the news operation works. They all listen to each other and go, "She was good, we'll have her."
Yeah, it was something like that.
Or
everyone else was ducking behind the sofa.
Generally, it's, that didn't work. Okay, whoosh. Or, oh, she was excellent, we'll have her. That's it. You were just simply too good, Sue.
You've got to recognise what an opportunity is and grasp it.
You certainly do. Now, okay, we're almost there. You've been very helpful. I'm an early days a single stock investor, and there's pretty much nothing that I don't get wrong sometimes. But I'm interested in the nuts and bolts, the technicals of how you actually invest, how long you hold for, and targets. How capital allocation, how much of your total fund you actually put into different stocks. Do you have any advice that you would give someone like me? I know I seem slightly old to be doing such things for the first time, but it's true. It's life.
You're never too old to learn, and I think that's an absolutely fantastic question. As an individual investor, you've got to ask yourself, what are you investing for? What are your objectives? Is it to beat the market, like I'm measured against the market?
Sure.
Or is it absolute returns? What are your risk tolerances for losses, capital losses? What's your time horizon? Is it 1 year, 6 months? Is it 5 years, 10 years? And what's that balance?
I hate losing money, and I would rather not gain money rather than lose it. I really hate losing it.
Yeah.
And 10% is what I'm trying to make on an annual basis.
And you can achieve that in different ways.
I'm of a certain age, but it annoys me when pension funds say, no, you're coming up to retirement, so you should be risk off. I'm as risk on as I've ever been, but cautiously.
Okay. And then you can have different components to your total return. How much do you want from income? Are you all about capital gains?
I haven't really got the hang of income. I should ask you about your income growth fund, because I have not got the hang of income. Should I be blending the two?
Well, absolutely. And if we take my special area of UK equities,
yes,
the long run returns have been about 7.5% in real terms. That's round numbers, about 10% in nominal terms. So what you were looking for. And about a third of that would come from income, your dividend yield. And the growth of that income is also
you simply
important.
reinvest it and compound it.
You can. So, you might think that something could be dull, but it could be worthy. And if you're not wanting to make many losses, you don't have to push the boat out and overreach. And I think you should think about diversification, not all the same themes, geographies,
I'm pretty good at
types.
that. It hasn't helped, but I'm pretty good at diversification.
And
they can still go down.
And then it's some of the fundamentals. So think about the risk of what you're investing in. How much do you really understand the business, how it makes its money? What's the balance sheet like? How indebted is it? Who are its competitors? Are you buying when everyone's euphoric? Are you buying because of FOMO, fear of missing out? Or do you think you've got hold of an idea that the market could get excited about? So those are the types of things I think individual investors should be asking themselves.
At what point, when you're all sitting there with the 4 people in your team, do you say, well, this is run as far as it's going to run. We think it's time to take the money off the table, because that's when retail investors tend to get in. That last 20% is when retail investors tend to appear. I'm afraid I'm probably one of those 20%.
So we retest and reevaluate all the investment cases within our portfolio for where are we in the investment case, what can still go right, and really sort of make sure that we're not leaving too much on the table, but we also have to know that we're not going to get it exactly right. As investors, we're going to get about half our decisions wrong. It's minimising the losses of what we get wrong and trying to maximise the gains from what we get right.
So how much would you top slice when you're actually taking your money back out? Do you go for 80%? Do you go for 90%? How much do you actually leave in?
It's a bit more of an art than a science.
Just in case there's a little bit more. That's what I'm doing at the moment. Once I begin to get anything over 10%, I start thinking,
recycle.
And I leave a little bit in just to see just in case it might kick on a little bit further.
It's a little bit different when you're running more institutional portfolios and managed against the benchmark rather than absolute returns, which I think a lot of individuals and retail investors who are looking at their own portfolios are thinking in absolute terms, aren't they? So we spend a lot of time thinking about the valuation guardrails of where a stock has traded in the past, as well as, well, are there any chinks in the investment case? What's happening to earnings? Have they got lots of growth opportunities? How excited is the market already on those?
Is the stock more likely to trade within its highs and lows rather than actually break out?
Yes. And then if it is breaking out, it's going back and challenging that. Have they got the capacity at the management level? Have they got the money to be able to do that? Or is that increasing the risks? Because it's difficult to grow. There are growing pains. It's not in a straight line. Sometimes you've got to invest before you get the returns.
Management stretch. There's only so much that a very able manager can actually do.
Indeed.
Sue Noffke, Head of UK Equities at Schroders. The time has flown by today. It has been a pleasure, and I wish Schroders, I wish you all the very best for 2026, and I hope that all your investments are blue.
Thank you.
Thank you. Now let me introduce you to the man behind the summit, Sam Bell, CEO at Copia Digital and Investment Summit co-founder. Sam's an experienced private investor, and what you need to know about him is that he's not afraid to take contrarian positions, whereas I'm more the cautious investor type. That's my nature. We're here to discuss stocks which we think are investable and to see how geopolitics and macroeconomics change things. None of this is investment advice, of course. Greetings, Sam. So we're just back from the mining indaba in Cape Town.
Just is the operative word there. I think it's been hours since we landed.
We're just off the plane.
Yeah.
So what is the mining indaba in Cape Town?
Well, you kindly introduced me to the idea. I hadn't realised it's been going on so long and that half of London disappears over there for the week. Really, really good time. Met lots of the PRs, brokers, people that we know from the UK, and lots of new ones as well. But yeah, essentially a big get together, right, of everyone in the natural resources sectors, and
in
then
the ecosystem.
Yeah, everyone that supports those companies as well. And of course, much of that is listed in London here, or if not, at least dual listed. So really good time.
And the slightly bizarre thing, it's actually easier to meet all these people in Cape Town.
Yeah,
and the
so many
Indaba.
people in one place, party after party, right? So,
But it's easier to actually see these people in Cape Town than it is to meet them in London.
yes, I mean, between us, probably got dozens of new contacts. So,
And
Very good idea.
very interesting people as well.
Yeah.
So I would say the most interesting people I met were Makengo Resources. I met them at the LSEG, London Stock Exchange Group. They had an informal...
weren't they putting out results while they were there as well?
Were they?
Somebody did. Oh no, I'm thinking of Orosur. Did they?
Orosur
They
Mining?
put out some results while they were there. So
Yes, as I met the
People-
chairman of Orosur Mining when I was there, Louis. Yeah, that was terrific. It's just such a useful place to be.
Yeah, it really is. And a lot of optimism in the air as well. I mean, if you're in the resources sector, you've probably had a pretty decent year. And it's hard not to be optimistic when you're stood in Cape Town with a beer in your hand and the sun shining down on you.
But finally, mining, after 10 or 15 years in the doldrums, mining is sexy again.
Yeah, and London as well, actually. I happened to go for lunch, and of course there's 30,000 people descend on Cape Town. So whatever restaurant, bar you pick, you're going to end up next to Indaba people. And there was a table of Australians next to me in one of the restaurants talking about, well, some of the deals that we've helped on as well, actually, but more specifically about London actually becoming quite a nice place to list, which, if we go back to what Sue's just been talking about, is something we need, right? I don't know if it was you or Sue that used the line, once it's gone with all these delistings.
I think I used it and then Sue picked up on it and agreed, yes, but once it's gone,
Yeah.
which is the tragedy, because there's so much M&A, because, FTSE 250 and lower, the valuations are very strong at the moment, or very weak,
And there's
depending on your perspective.
a lot of people pulling together to make London a much more attractive listing destination, but the valuation's got to be right. Tech, of course, often chooses NASDAQ and so on. But yeah, just in general, if we've got lower valuations than other jurisdictions, founders are always going to pick where they're going to get the most bang for their buck, or buck for their bang, whichever way.
But mining is a strength of the London Stock Exchange. And I think sometimes we're too quick to put the UK down, but actually we have real strengths in the mining sector. So it is a bit of a
financial
horror.
services similar as well,
And the number of lawyers and accountants, top, who bring all their excellence and expertise, and they were all to be had at the Indaba as well. So it's a useful reminder of how powerful the UK can be in terms of financial services.
Really was. It'd be nice if we could replicate something similar in the UK, actually, bringing more and more people together. So perhaps investor summit on a larger scale.
I was going to say, perhaps we need to put a spin at. We need to have more mining companies in the investor summit, which is going to be, September?
Yes, middle of September. Date to be announced any time now.
Well, we've got to have more mining companies there. That's what I would say, Sam.
Yeah, but more companies in general would be brilliant. Got good retail and higher and sort of professional audience as well. Good few professionals attended last time, didn't they?
So, what would you say? We're just off the plane from the Indaba. How would you summarise the whole thing?
I'd go back to that word optimism. Lots and lots of optimism. As I say, not even just about mining, about the UK as a place to list. Sounds like through the grapevine, there's some stuff on its way. It's quite a healthy pipeline of companies.
More IPOs, more placings. Is that what you're alluding to?
Yeah, exactly. And part of that, I think, is this big retail push. So, retail's providing some decent extra liquidity. People are realising that. Even in the fixed income side now, people are pushing bonds towards retail. You picked up on this with Sue, didn't you? About some of that income as well as just capital.
She
growth.
runs an income growth investment trust,
So it's important,
as well as the 6 billion of Schroders funds.
Yeah, important to get that mix right. But to make the same point again, a lot of this is going to hinge on valuation and making sure we have decent valuations. So what's that catalyst going to be that gets more and more people investing in the UK? Some people think, if the Magnificent Seven cracks, where does that money flow to? Mm-hmm. But one of the answers, as has unfortunately been the case for so many decades in the UK, is often cash. Some of it could go into fixed income. It'd be nice to see some of it flow back into UK equities. That would be
some of those American funds are already coming into Europe, are already coming into the UK. They're going into emerging markets. So I think the whole of the world has actually become a bit of a beneficiary of the fact that people think the Mag 7 will crack.
I mean, we were talking about
they're taking money off the table, which is a sensible thing, I think.
Yeah, talking of catalysts, as you say, like the Americans certainly noticed lots of bids coming through. Activists, LSEG now's got activist investors.
Elliott,
yeah. Saba is always causing the trouble they do, but bringing a focus onto undervaluation. So I think bringing all of that together, we should.
You're a bit of a contrarian, so do you think activism is a force for good, or can be a force for good?
Yeah, I think so. There's plenty of complacent managers of businesses and funds on the UK market, so the activism wouldn't work unless there was, an edge to be had. So these people know what they're doing. Not always done in the right way. Should put that there, but I think there's absolutely a place for activist investors.
Okay.
Yeah.
Sam Bell, wonderful as always. I look forward to speaking to you in 2 or 3 weeks' time. We've got a lot of fall in the studio.
Lord Adventure.
Lord Adventure in 2 or 3 weeks' time. Until then,
look forward to it. See you then.
Good to chat. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. This Investor Summit Green Room podcast is produced by Copia, creators of investor events, video, and websites. If you've enjoyed our monthly podcast, please do subscribe on YouTube or follow us on your own podcast platform. And of course, we'd love to hear from you.